Did you know there's probably a tax-deferred time bomb in your retirement plans? No! Yep. And if we don't work to defuse it, we are probably overlooking the single most damaging force to your retirement. So that means we need to talk about taxes. But remember, your retirement dollars will be taxed at some future and unknown rate. And if you don't know how much you will pay in taxes, do you really know how much retirement money you have? Okay, so let's get into it. Enough of that silliness. Right, quick refresher. Taxes are calculated in brackets. It's kind of like one of those graduated cylinders that we used to use in science class. Science! Hold that thought. And you would fill up the graduated cylinder with income, and each additional amount of income is taxed at a different rate. Under current law, for example, married filing jointly, your first $15,700 of income will be taxed at 10%. Anything over that and up to $59,850 is taxed at 12%. But remember, also, married filing jointly couples get a standard deduction of $22,500. So really, the first $22,500 you earn is exempt from taxation. Then from there up to $95,350 is taxed at 22%, up to $182,000 is taxed at 24%, then 32% for up to $231,000, 35% for up to $578,000, and finally the highest marginal tax bracket is 37% for any income above that. And when you contribute to a tax-qualified retirement plan like an IRA or 401k, you defer income taxation until you eventually withdraw it. And then you will pay tax on whatever income you take at whatever tax bracket you happen to be at that time. Most people save into a 401k and IRA assuming they will be in a lower tax bracket when they choose to retire. But how realistic is that? Will you really be in a lower tax bracket when you choose to stop working? What? That's right, there's several possible snags here. Number one, most people choose to retire in the same lifestyle they had when they were working. The whole idea of retirement planning is to continue the lifestyle you've become accustomed to. So what that means, same level of income, same level of taxation. Number two, a lot of folks can't sit still in retirement. Many folks won't stop working, they just change careers. They'll run a flower stand or repair motorcycles, which means they continue to earn on top of Social Security, pensions, or IRA withdrawals. More income, more taxation. Coming in at number three on the hit parade, tax brackets are changed by Congress all the time and frankly are likely to go up in the future. Even if Congress does nothing, taxes are automatically planned by law to increase in 2026. And we all know Congress is really good at doing nothing. Beginning in 2026, the highest marginal tax bracket will change from 37% to 39.6%. And myself and many other smart people believe that this is only the beginning of future tax increases. Number four. At age 73, the IRS will require you to take distributions from your retirement plans and pay taxes on those distributions. And the formula that they have in mind for you may force you into a new and higher tax bracket. You might find that you have the privilege of paying more in taxes to get the monies out than you saved when you put it in. Also, distributions from your retirement plans, either forced or voluntary, also count towards provisional income. And what is provisional income, you may ask? Good question. It's the income that is counted towards determining whether your Social Security will be taxed or not, and at what rate. So yes, required minimum distributions, forced distributions from your retirement plans, which are taxable, also cause more taxes to be paid on your Social Security. Good times! You may not know this, but there is an ideal amount for you to have in your 401k if you wish to be in the zero tax bracket. Zero! And that is the amount where your required minimum distribution does not exceed the standard deduction. Now, some of you may remember that President Biden recently proposed a new budget earlier this year, and he came on television frequently with one certain soundbite: nobody who makes less than $400,000 a year will see their taxes go up. Now, it may seem that only a small sliver of the population makes more than $400,000. But consider this. Your RMDs alone could easily push you over the $400,000 limit. We did the math. If you have $1 million in your retirement plan earning 8% at age 60, by age 73 and RMD time, it would have grown to over $2.8 million. Your first RMD distribution would be about $126,000, but would increase to nearly $400,000 by age 90. And now you are one of those people who are seeing your taxes increase under the proposed budget. You see, it's all connected. Like this ruler here. If I move one end of this ruler, the other end is going to move also. And unless I can predict where that other end of that ruler is going to go, do I really know the outcome of my decisions? So where do you think the tax stick is going? Up or down? Well, how about a brief history lesson? Right. Do you know what was the highest tax bracket in history? It was 94%, and it was during 1944 during World War II. Even as recently as the 1970s through 1980s, the top marginal tax bracket was as high as 70%. So that would imply that we are currently in some of the lowest tax brackets in history. In fact, the only time it was lower was in the 1920s and briefly during the Ronald Reagan presidency. But do we think it will stay that way? I'm not convinced. What do you think? Do you think taxes will be higher or lower again in the future? The future! It made sense to defer income then with the hopes that tax brackets would be lower in the future. And that sort of worked out. But will it continue? I have my doubts. And again, I ask you, if you don't know what tax bracket you will be in when you withdraw your 401k dollars, do you really know how much money you have? Income tax rates are changed all the time. Here's a chart that shows how often that has happened. Remember, taxes pay for things that Congress has already agreed to purchase or spend money on. And Congress is constantly spending more and more and more. And our current tax revenues can't cover what Congress has already committed to spend. Which implies there's plenty of room for Congress to increase taxes in the future. And many experts think that taxes will have to double in order to reduce our national debt. And that's the fifth reason we think taxes are going up. National debt has increased dramatically over the COVID years. But even prior to that, it was over 20 trillion. Now the national debt is over 31 trillion, more than 1/3 higher than the pre-COVID era. And the recent debt ceiling agreement increases that level to 34 trillion. But that only counts the money we've already spent. If you consider the commitments we have made to spend monies in the future, the national debt is closer to 239 trillion. So how are we going to pay for that? You guessed it, higher taxes. So, what if all of your income was exempt from taxation? You would be in the zero tax bracket. And if taxes double, well, twice zero is still zero. I think we should consider the possibility that it might make sense to pay some taxes now at a known and controllable rate, rather than deferring it into the future at an unknown and likely higher rate. I know. It goes against all logical thinking to think we should pay taxes today. That is, unless you believe the taxes will be higher in the future, and then it makes all the sense in the world. So obviously, contribute up to the matching amount in your 401k to get the free money. But what if you contributed everything else beyond that to a taxable account? What advantage would that give you? Well, one possibility is it makes Roth conversions possible. Roth conversions! One of the most powerful tax strategies you can implement. Remember that Roths are tax-free forever. If you happen to pick the next Google stock and it goes to a bajillion, it would all be tax-free. So imagine, instead of maxing your 401k, what if you only contributed to the matching level and anything else beyond that you put into a savings account or investment account? Then, when you choose to retire, you would live off of the savings for a little while, because that money has already been taxed when you earned it, and when you withdraw it to live off of, you pay 0 in taxes. And if tax rates go up in the future, well, twice 0 is still 0. And now you would convert some of your 401k dollars into Roth dollars. And at what tax rate? Your current tax rate. Do that year after year after year, and you could convert a sizable amount of your 401k into a Roth IRA, then have tax-free gains forever. These are just a few of several simple, powerful tax strategies that exist to leverage advantaged accounts such as Roths, HSAs, 529s, and even stock options or regular stocks to help you get to the 0 tax bracket. We believe this is so important that this is our new strategic initiative that I imagine we will be working on for probably the next 10 years with our clients and friends. So, if you could be in the perfect tax bracket, what would it be? 0! I'm also very pleased to tell you we've entered into a strategic partnership with David McKnight, author of The Power of Zero, and also Tax-Free Income for Life, and his team who has the power, tools, and experience to help our clients get to the 0 tax bracket. I hope this little video helps to illustrate how we think that the tax train is coming, and I hope you'll join me to learn more about how all of this works and join me on the path to getting to 0. And as always, thank you for your continued confidence in the work that we do.